You finally reach the age when your pension becomes accessible. The account shows a balance you spent decades building. With a few clicks, you could take tax-free cash, clear a debt, renovate your home, help your children, or enjoy some of the money you worked so hard to save. But one withdrawal can trigger consequences that may follow you for years. You could receive much less than expected because of emergency tax. You could permanently reduce how much you are allowed to contribute later. You could discover that 25% tax-free does not mean every pound you imagined. And accessing your pension could affect your benefits or even change your retirement date. This does not mean you should never touch your pension. It means you should understand these 5 hidden rules before the first payment leaves your account.
Modern pensions offer flexibility. You may be able to take a lump sum, withdraw gradually, buy a guaranteed income, or leave the pension invested. But flexibility creates choices, and choices made in the wrong order can cause tax, contribution, and cash flow problems that may be difficult to reverse.
Click Confirmation. By the end of this video, you will understand what tax-free pension cash really means, why your first withdrawal may be overtaxed, how taking taxable money can restrict future saving, when the pension access age changes, and how withdrawals may affect means-tested support. If you enjoy practical videos about pensions, tax, and retirement planning, subscribe because we upload videos like this every week. Transition. Let's begin with the pension rule almost everyone has heard about, but few people understand completely.
Hidden Rule 1. 25% tax-free has limits. Many people believe 1/4 of every pension they own can be withdrawn tax-free without restriction. Usually, you can take up to around 25% of a defined contribution pension without paying income tax. However, there is also an overall tax-free lump sum allowance across your pensions. For most people, that total is roughly £268,000, although protected rights may change the position. The allowance applies across your pension arrangements, not separately to every account. You also do not have to take the entire tax-free amount immediately. That matters because taking the maximum on day one can leave a large amount of cash outside the pension and less money invested to support future income. Imagine someone taking tax-free cash simply because it is available, then leaving it in an ordinary bank account. The money may earn taxable interest, lose purchasing power to inflation, or disappear through unnecessary spending. Tax-free does not automatically mean financially sensible.
Before withdrawing, ask, what specific purpose does this money have? If there is no clear answer, availability alone may not be a strong enough reason to take it. Open loop. But the tax-free portion is only the beginning, because once taxable money becomes part of the payment, the next rule can create an immediate shock. Hidden Rule 2. Your first withdrawal may be overtaxed. Imagine requesting pension money to pay for an urgent home repair. You expect part of the payment to be tax-free and the rest taxed according to your normal yearly income. Then the money arrives, and the deduction is far larger than expected. Pension providers may use a temporary or emergency tax code when making an initial flexible withdrawal. The tax system can treat that payment as though you will receive a similar amount every month for the rest of the tax year. A one-off withdrawal can therefore temporarily look like an extremely high annual income. The deduction may be much larger than your true final tax bill. HMRC may correct it later, or you may request a refund, but the short-term cash flow problem is real. There is another risk. The taxable part is added to your other taxable income for that year. Your salary, state pension, private pensions, rent, and taxable savings interest may all affect the final calculation. A withdrawal that appears affordable by itself could push more of your income into a higher tax band.
So calculate your combined annual income, not just the amount leaving the pension. Pattern interrupt. Your pension provider sees a withdrawal. HMRC sees taxable income. and those perspectives can produce a completely different number from the one you expected.
But taking taxable money flexibly from a defined contribution pension will normally trigger the Money Purchase Annual Allowance, or MPAA. For 2026-27, the standard pension annual allowance is generally around $60,000. Once the MPAA is triggered, the amount that can usually enter defined contribution pensions with tax advantages falls to around $10,000 a year. That lower amount includes personal contributions, tax relief, and employer payments. This can become a serious problem for someone who returns to full-time work, receives generous employer contributions, or plans to increase pension saving during their final working years. Taking only tax-free cash will not normally trigger the MPAA. Taking flexible taxable income usually will. Before accessing anything, ask your provider whether the withdrawal option will trigger it. Do not assume a small payment has no consequences. The effect depends on the type of withdrawal, not whether the amount feels small.
You may now be thinking, at least I know I can access my pension from 55. But even that rule is changing. Hidden Rule 4. The access age is moving. At present, most people can usually access private pension money from age 55. From 6 April 2028, the normal minimum pension age is scheduled to rise to 57. Some people may hold a protected pension age, while limited exceptions can apply in situations such as serious ill health. Someone planning to leave work at 55 could therefore face a 2-year income gap if they have not checked their pension rules. That gap may need to be funded through an ISA, cash savings, part-time work, or another income source. The mistake is building your retirement plan around an age you saw in an old brochure or heard from someone else. Check the rules of your own pension scheme. If you have several pensions, do not assume they all have the same access conditions or protected benefits.
Hidden Rule 5. A withdrawal can affect benefits. Pension money can be treated differently depending on where it is held and how it is withdrawn. Taking money may increase your income or the capital sitting in your bank accounts. That could affect entitlement to means-tested benefits. For people over state pension age, even an untouched pension pot may be considered when pension credit is assessed through rules involving actual or notional income. This means taking a lump sum to improve cash flow could reduce financial support elsewhere. Pension, tax, and benefit decisions should not be planned separately. A withdrawal that appears efficient for tax purposes may create a disadvantage elsewhere. Before taking money, use a benefits calculator or seek specialist guidance if you receive or expect to claim means-tested support.
How to protect yourself before withdrawing. First, identify which type of pension you have. Defined benefit and defined contribution pensions follow different rules and offer different options. Second, request a written breakdown from your provider. Ask how much will be tax-free, how much taxable, which tax code may be used, and whether the option triggers the MPAA. Third, calculate your expected income for the entire tax year. Include employment, the state pension, other pensions, rent, and taxable savings. Fourth, decide whether you genuinely need the entire amount immediately. Phased withdrawals may provide more control than one large payment, although charges and investment risks still matter. Fifth, check how you will fund any period between leaving work and reaching pension access age. Finally, consider PensionWise. It offers free and impartial guidance for eligible people with UK defined contribution pensions. Guidance is not personalized financial advice, but it can help you understand your choices before making a decision that cannot easily be reversed. Recap. Let's bring the 5 hidden rules together. Rule 1. Tax-free cash is normally limited to around a quarter of your pension, subject to an overall allowance, and you do not have to take it all immediately. Rule 2. Your first flexible withdrawal may face emergency tax,
while the taxable part is added to your other income for the year. Rule 3. Taking flexible taxable income can trigger the MPAA and sharply reduce how much you can later contribute to a defined contribution pension with tax advantages. Rule 4. The normal minimum pension age is due to rise from 55 to 57 in April 2028 for most people. Rule 5. Pension withdrawals can change your income or savings and may affect means tested. Your pension may become one of the largest financial assets you ever own. But your first withdrawal is not simply a banking transaction. It can change your tax position, your future contribution limits, your retirement date, your benefit entitlement, and the amount left to support you later in life. So do not touch your pension simply because the account has become available. Know which type of payment you are taking, know what it could trigger, and understand how it interacts with the rest of your finances. A few minutes of careful planning could protect decades of retirement income. If you found this video useful, like, subscribe, and turn on notifications for more practical videos about UK pensions, taxes, and long-term financial security. Thanks for watching, and I'll see you in the next video.